Hello and welcome to Sanders Family Office's presentation on our exclusive and proprietary GLC lending opportunity, formed in partnership with Grandland Corporation. My name is Luke Sanders, and I am the president of Sanders Family Office, and I'll be very excited to be taking you through this presentation over the next 25 minutes or so. A little bit about Sanders Family Office before we begin. Sanders Family Office works firstly and primarily to manage the wealth and the assets of the Sanders family. And in the course of doing so, we work to curate and tailor various types of alternative investment opportunities. This GLC product, which we will be looking through over the next several slides, is one such alternative investment. We do so firstly for our own investment purposes, so we are always first money in to every alternative structure that we put together. But we also make these offerings available on a select basis to our network of agents and affiliate partners. So I would like to stress in welcoming you onto this presentation that your access to this offering is a function of a fairly close-knit relationship that Sanders Family Office has between ourselves and the agent or agent group that invited you as a guest to view this offering. So before we dive into the specifics of the GLC product, we're going to just give a brief overview of what we'll be looking at. We're going to begin generally. We're going to give ourselves a context and a frame of reference to better appreciate the specifics and the details about this proprietary offering. And as we look into those specific features that really highlight the structure of this product, we're going to filter that through the lens or distill that down to two central features that I would say anyone could consider the two central pillars of any investment consideration. And that would be firstly, on the one hand, security, collateral, protection, risk mitigation structures, essentially addressing that fundamental question of how safe is my money? And the other side of that coin, or that second pillar that we will be considering, is represented by the question, how hard is my money working for me? And we're going to look there at the interest and the return structure as well. So both of those complement each other, and we're going to focus the summary around those two central features. So to begin, generally speaking, to give ourselves again that context, this product is structured as a lending opportunity. This is structured as a debt instrument. And we find it important to state that at the outset because, of course, as you see on the screen here, we are using the words real estate, and you'll be seeing pictures of properties on the following slides. And real estate can have a variety of different connotations as it relates to the investment world, depending upon our own experience and our own background and our own affiliation with various types of investments into real estate or surrounding real estate products. By contrast to what could be called an equity position in real estate, in other words, some kind of ownership or partial ownership position of real estate assets or investment directly into particular properties, this GLC product is structured as a debt instrument, as a loan. You are making a loan to the namesake of this offering, Grandland Corporation, or GLC for short. More on them in just a moment. And where real estate comes in relation to you as the lender is in the form of collateral for that loan. And we'll spell out on the following slide what that process looks like in a little bit more detail. But at the moment, to give ourselves a general overview, as we're taking these bullet points one by one, we've just noted that these loans are secured by real estate assets. Now, in terms of the frequency of the return, we've striven to give a variety to our clients in order to cater to various types of needs. So we have structured loan options that have a payout on a cash flowing basis, either monthly or quarterly. And we've also structured a loan option that has what we call an accrued or deferred return structure that pays out, has no cash flow, but pays out as a lump sum at the maturity of the loan, but by virtue of that fact, offers a more outsized total return on the loan. Now, we will cover each of the loan options specifically in the final slides, but just to give a little foretaste of what that will look like, the current interest rate on the cash flowing options comes in at a rate of 1% per month on the options which pay monthly, or 3% per quarter on the options which pay quarterly. I will reiterate this in the final slides of the presentation, but very important to note at this point that all of the interest returns that you will see corresponding to the loan options are fixed rates of return. These do not fluctuate. They are not variable. They will not change throughout the entire duration of your loan option. And what that does for you as the lender is afford you a tremendous amount of predictability, precision, as well as clarity and transparency when it comes to calculating the return that this represents on your principal. You can calculate for yourself right down to the dollar amount, precisely what that cash flow will be or what that total return will be at maturity, right down to the dollar amount, by virtue of this structure that we have put in place for fixed returns on all of the loan notes. Now, in terms of the effective annual interest, when all of the different interest components are accounted for, that will range on our loan options from a baseline of 12%, so already a strong baseline return in the double digits, all the way up to a 33% effective annual interest. Of course, the returns are fixed, of course, but each loan option is packaged differently, and that's where that range comes from. Now, the last point to note before diving into the specifics of the security and collateral structure is that we have structured these loan options with a fairly short to moderate duration. So you can see here, the options will range in duration from 12 to 24 to 36 months, 1 to 3 years. Now, this is an easy point to gloss over, but it bears emphasizing that this is yet another feature that redounds to the benefit of the lender. Now, why is that? Well, that affords the lender more flexibility, more maneuverability when it comes to that future-facing aspect of his or her investment finances. Precisely because you do not have to lock down your principal for an extended duration in order to realize these kinds of competitive and outsized returns. By contrast, there are other types of vehicles and products out there that in order to secure a higher return or a higher range for a return, you have to essentially lock down your principal for an extended period of time, could 5 years, 10 years or more, depending upon the kind of structure one might be looking at. And again, by contrast, this provides you more maneuverability because at the maturity of all of these loan options, the lender is in the driver's seat. Our clients are in the driver's seat. You have the prerogative to either terminate that contract and receive your principal back if you have a different allocation. However, you also have the option to renew upon the maturity into a subsequent loan contract of the same or a different duration. So it really does afford you a very high degree of nimbleness, let's say, financially speaking, with that investment finances when it comes to the shorter durations and what can be done at the maturity of those contracts. Now, having provided a general context in a summary, we've talked about this is a lending opportunity collateralized by real estate, relatively short terms, cash flowing, or deferred options available. We'll begin to focus on these two pillars that I mentioned at the outset. Now, the first of those being, again, how safe is my money? What is the security? What is the collateralization? What does that structure look like? Well, in order to spell that out in a bit greater detail, we'll say a few words about our partner in this offering, and that is the borrower. That's the namesake of this product, the company by the name of Grandland Corporation, or GLC for short. Now, GLC is, among other things, a real estate investment and management company. GLC controls a diversified income-generating and developmental real estate portfolio currently valued in excess of $186 million. That portfolio is actively growing, and on the following slides, I'll give a little bit of a foreshadow or a forecast of what is to come with new acquisitions coming into the portfolio. But as it stands, current value at 186 million plus. What GLC has done for the benefit of the lenders is to pledge the entirety of this portfolio, all of these assets, to the lenders to back, secure, and collateralize these loans. You can look at that as the first and primary layer of armor or protection for these loans. An important point of emphasis here is that, firstly, GLC owns the portfolio assets outright. The portfolio is 99% plus free of any senior debt. There's only a small amount of senior debt remaining on some of the smaller assets. But essentially, virtually that asset, or that portfolio rather, is owned outright. And these assets are pledged exclusively to the GLC lenders with a 75% loan to value cap, meaning that the total amount of debt that can be brought on over and against this portfolio cannot exceed 3/4 or 75% of the total value of the portfolio. Now, what that does, of course, is leave a nice sleeve or buffer of 25% of the value in these assets that is not going to be leveraged. And that is, of course, to allow for that buffer room for contingencies. Obviously, this is a diversified portfolio and is growing, but real estate fluctuates, can fluctuate in value, of course. And so to allow for that room always ensures that the portfolio is never over leveraged and that there always remains sufficient collateral to properly and fully cover the GLC lender's debt obligations. Now, again, that is the first layer of armor or protection for the GLC loans. In addition to that, what Sanders Family Office has done is to bring on an additional layer of security that we have grafted on. And that secondary layer of protection occurs by way of a partnership between GLC, the borrower, and a third party that we've brought on to act as a custodian over the borrower, namely Minor Family Office. It may not surprise you that as a family office, one of our greatest assets is actually not any one particular investment, but is our network. So in the course of forming these partnerships and tailoring various alternative investment offerings, we work with a variety of different partners, and that includes other like-minded family offices with various areas of expertise. In this case, Minor Family Office has a strong background in real estate investment and management, which makes them a perfect candidate for this custodial role. Now, how, as I'm sure the question has occurred in your mind, how does having a custodian, third party, acting in that capacity over the borrower, GLC, translate to additional lender security and control, as you see on the screen there? That I can boil down to two basic and fundamental answers. The first of those is that the custodian provides accountability and active oversight over GLC, the borrower. GLC is obliged to provide reporting on a monthly basis to the custodian, specifically focusing on those portfolio assets. And that is to ensure that all of those properties in the portfolio remain healthy and remain in good standing, that they continue to serve their proper function as healthy collateral for the lenders. So that is to ensure that these assets are not impaired, they are not encumbered, there have been no liens taken out against the properties, and a variety of other conditions that have to be met, once more again, to ensure that these assets remain healthy as collateral for the lenders. So you can look at that as the custodian keeping their thumb on the pulse, as it were, as a representative of the lenders at large on the state of the portfolio month to month to ensure that it remains healthy within set parameters. The second major role that the custodian plays is in a worst case scenario. So we are often asked that question of what is the worst that could happen and what has been done to address that kind of circumstance. Well, given that this is a lending opportunity and we've briefly talked about the interest payout structure, that scenario would look like a default, meaning primarily either that there's a delinquency on the interest payments, let's say on the quarterly paying option, that the borrower misses a quarterly interest payment, or a delinquency on return of principal or something similar. That would be an instance of a default. Now, in a default situation, the borrower, GLC, is given a short window of time in which to get back on track, in which to remedy that default. But if GLC is unable to do so for whatever the reason, then within that short window, then that escalates from a default to what is then called an incurable default. Now, it's precisely in that incurable default scenario that the custodian, on behalf of us as the lenders, is empowered to step in, intercede, and act directly for our benefit. As a matter of fact, I often like to compare the custodian to the role of a personal bodyguard, someone who's been hired on and whose sole responsibility is to be by your side, to keep their eyes on the situation, and to step in at the first sign of trouble for your protection. So should there be an instance of incurable default, the custodian is empowered to step in and to take control of that entire collateral portfolio, $186 million plus of real estate assets, away from GLC, the borrower, and is then empowered to administer and dispose of those assets as necessary to access the liquidity in those properties to make the lender whole. And by that, we mean full repayment of principal and any unpaid interest. So, of course, that can entail liquidation, sale of certain of the assets, or parceling out of the larger assets and selling portions, or even if a sale would be more of a protracted sale, depending on the asset and the debt obligation that remains is only so large. That can also mean refinancing or drawing out a line of credit on an asset. All variety of ways to, again, access the liquidity in these real estate assets to ensure that the lenders are fully repaid. So when you can summarize this security structure, you can really bring that down to two key features or two tiers. The first is that the borrower GLC is pledged their diversified developmental and income generating real estate portfolio, 186 million plus currently, but growing, to the GLC lenders as collateral. Secondly, the borrower has made themselves beholden to a third-party custodian and given that custodian the power, the authority, and the ability, should there ever be a default, should the borrower not meet that debt obligation to the lender in a very stringent manner, to take control of all those assets and liquidate, sell, refinance, whatever it may need to be to fully repay the lenders. So in terms of the shifting of the risk mitigation, the shifting of the risk burden off the shoulders of the lenders, we have done substantial work in the structure of this offering to move that onto the shoulders really of the borrower, because the borrower stands to, in theory, lose $186 million in their real estate assets, to have those taken away from them and sold, simply so that the lender can be assured of full repayment of principal and unpaid interest. Now, shifting gears to some of the portfolio assets, obviously to give a little bit more of an insight as to what stands behind that rather large $186 million number. What we've done is, this is not an exhaustive list in this presentation, but we are highlighting some of the exciting assets that are in the process of currently being developed or new acquisitions, really to give a sense of the trajectory of GLC moving forward, and also to give a demonstration of proof of concept, as it were, of the GLC financing actively at work. And in no asset currently, at the present moment, is this better exemplified than in the Kala Leibach Balus project. Now, Leibach Balus is actually a city district that is located in southern Jakarta, which is Indonesia's massive capital, actually the largest city in Southeast Asia with a population of over 10 million people, and the broader metropolitan area that increases to over 35 million people. So very dense population center and an economic and political hub as well. This asset is essentially a commercial asset that is currently being renovated in the final stages of renovation. Actually, as of the time of this recording, the beginning of May of 2023, within a month, this asset is set for a soft open, and it is being renovated to serve as a combined cafe, retail, performance, and leisure space, roughly equivalent to what you could think of as a small shopping center, small shopping mall, from what we would be used to. You can see on the designs here from the vertical, the rendering of that layout and color coded according to those different types of uses and designations. So you can see here the two-story building being utilized for this large balcony and front-facing portion to house the cafe, as well as this open atrium space housing the 2 stories as well of various retail locations. And then the yard space with these beautiful foliage and banyan trees with built-in amphitheater to serve as that leisure and potential for entertainment venue as well. So very exciting for this asset. And again, this is really the model and the approach from GLC's perspective. The purpose of this financing is to allow GLC to make new value-added acquisitions into their portfolio and to build these assets up into cash flowing properties and assets. And this actually is a feature which benefits the lenders as well, because as GLC takes these kinds of assets, brings them into the portfolio and renovates them, then that is, because these assets are pledged to the lenders, then that simply increases the diversity and the overall value and the overall equity in that portfolio that is pledged to the lenders. So again, a very elegant kind of balancing here. As GLC grows and improves, the lenders also benefit indirectly insofar as their collateral pool is constantly increasing and being infused with additional value. You can see here as well renderings of the various aspects of the internal space. In fact, the word kala, as we saw on the slide a few slides back, is a Balinese word that means time. So this is actually the concept that is governing this renovation, is really to create a layering of old and new, and that includes materials as well as different time periods. So you can see certain more modern elements in the atrium space, as with in that balcony spaces, a little bit more of the traditional kind of minimalistic almost design, and that interplay between the two. So again, very exciting asset, the Kala Leibach Belus project. This asset is set again within about a month's time for soft open, and is estimated value at open to be in the $7 to $10 million range. So again, that will bring the portfolio value in very short order closer now to 200 million, and with additional projects soon to come well beyond that. Just to look at a few other assets in the portfolio, again, not an exhaustive list, but just to give a sense of some of what's again behind that portfolio total asset value number. Another current operational business in the portfolio is the Chill House. This is a lifestyle retreat that, as you can see here, has numerous different villas for short and medium-term stays. A swimming pool, offers various types of therapeutic treatments and yoga sessions, and so forth. A brief note before moving on to the subsequent slides is you will have noticed already that two of the portfolio assets and several more are located in various locations within Indonesia. And that can be a new consideration for many of our prospective clients. Many of our clients have never themselves been to Indonesia and might not know some of the dynamics about what that area of the world represents. To give just a very brief window in this presentation of why at Sanders Family Office we chose to partner with GLC and to bring this model of financing, with which we actually have prior experience with sister products, into this part of the world, is really, this is the result of several years of due diligence on our end. And as we came to understand the ways in which Indonesia is in many respects a burgeoning and rising theater in terms of investment demand and the economic strength, I will mention briefly only two factors. The first being that in last year, that is 2022, Indonesia experienced economic growth, GDP growth, which outpaced their inflation numbers. In other words, their economy grew more than their inflation did. In the United States, by contrast, we had inflation numbers that were several times our economic growth. We actually debated whether we were in a recession or not. And that's just to give an emphasis about how even on the global scale, many sectors are going through volatile periods. There are certain areas that are naturally a little bit more hedged against some of these risks that even we're experiencing here in the United States. The other brief point that I will mention is that the foreign direct investment demand into Indonesia, it has been growing tremendously over the last many years. And a great example from 2022 is that Tesla signed a $5 billion nickel deal with the government of Indonesia. Indonesia being tremendously commodity rich, especially with the industrial metals, and are actually in the final stages of working to cement an infrastructure deal as well, not merely to export the raw resource, but actually to build a gigafactory in Indonesia. So those are just some of the features of a little bit of a background about the strengths that this global diversification in terms of the collateralization for our GLC lenders, the real strength that these Indonesian assets represent. To continue, the additional assets in the portfolio are two, soon to be three, retail coffee locations. These are the Bali Coffee Club locations serving high quality Balinese coffee, as well as food, so food and beverage together. This asset here is located in a very traditional, and as you can see by the photos already, a very lush and naturally beautiful region of Bali called Ubud. It's a high tourist destination as well. This is a great example of a developmental asset in an earlier phase. So we saw the Kala Leibach Balus project is essentially right about at completion, ready for open. This asset is in an earlier stage, but again, represents the tremendous potential of the portfolio as equity is infused into this asset and it is developed to dramatically and drastically expand the value of this asset, as well as to, of course, create a new source of cash flow for GLC. Just to give a little bit of an insight into what is to come in the future, this asset is set to be developed as a luxury glamping location. Glamping meaning glamorous camping. So don't think tents and s'mores by the fire, but really a very luxury experience that still leaves you with a high degree of exposure to, again, what is a very tremendous and obvious natural beauty in the surrounding areas. So you can see on these slides just a little bit of an indication of the type of inspiration and the overall design layout that this project is intended to have. These beautiful individual units that are based and modeled off of organic shapes in nature, such as mahogany shells, and of course the use of bamboo in this area of the world as tremendously pliable and versatile, can be used to great effect with these kinds of natural shapes and designs. And you can see here as well that utilizing the terraced hillside approach for villas and pools and so forth, and a little bit more just of a rough sketch with some of the concept of what that is to look like. Again, a glamping concept inspired by nature, utilizing sort of a floating platform approach that has a minimal impact on the vibrancy and the lushness of the foliage around it, and also just allows for ease of transport, almost as it were floating through and above the beautiful jungle area. In addition, the property borders the Ayung River, a very beautiful river location. So to incorporate a restaurant location that actually floats out and over the river once more, giving that wonderful level of exposure to the natural beauty, which is perhaps the greatest aspect of this particular asset. Very briefly, before we move forward, just to highlight more new acquisitions and more of the growth of the GLC portfolio. GLC has made acquisitions in the continental US as well as in US territories. So by no means is the portfolio limited to Indonesia or the Southeast Asian Pacific. This is one example of a new acquisition in Lake County, California, which is just north of Napa County, northeast of Sonoma, the famous wine growing regions. This is a 9-acre property located on a ridgetop over a beautiful peninsula that looks over gorgeous Clear Lake, which is in fact the largest freshwater lake that is completely enclosed by the state of California. This, given the pristine panoramic views and location, this asset is being considered for development as a wellness spa location. And there will be part of the mandate for GLC in 2023 and beyond is to make more strategic acquisitions in the continental US as well. So we will look at just a few of the faces behind the names of the parties involved, just to give a better sense of who's who before we conclude this presentation with the loan options themselves. GLC is led by two co-directors. The first of those co-directors is Ms. Dion Desiana. Now, Ms. Desiana has a very extensive and profound background in the hospitality space. You will have noticed for the existing and intended developmental assets that there's a broad theme that unites these kinds of properties. And broadly speaking, these are developed or are to be developed in the hospitality types of projects. And again, that's a fairly broad umbrella, but that includes hotel locations, resorts, retreats. As you can see, retail and food and beverage as well. amongst other types of developments. So given Ms. Dion's extensive background in hospitality space, working in a variety of capacities from accounting to general affairs management to human resources, her expertise lends a tremendous amount of insight into the development of these various assets in the portfolio. About a decade ago, Dion joined Top Hotels, Hotels and Resorts. That organization manages about 23 different hotel and resort locations throughout Indonesia and Malaysia. So once again, her expertise in this industry, as well as her saturation in this part of the world, makes Dion Desiana a very prime leader in informing the direction of Grandland Corporation. The second co-director of GLC is also the senior managing director of Sanders Family Office. So while Sanders Family Office is not what you would call a principal to the offering, we are not the borrower, we are not the custodian, we have formed this offering and brought it together. We did want to position ourselves in forming this partnership to keep our own thumb on the pulse and to be able to have more of a direct insight into the trajectory and the future development and where GLC is moving in terms of its expansion and enhancement of its portfolio. So in so doing, we established Margaret Sanders as the second co-director of Grandland Corporation. Now, Margaret Sanders has a over 30 years background in the financial services space. At one point, she owned an IMO, an insurance marketing organization, with over 1,000 agents underneath her. And after having sold that company, moved on to other types of investments within the family office context, having a strong background in real estate investment as well. So between the twin leadership at the helm of Dion Desiana and Margaret Sanders, that forms the direction of the movement forward for the Grandland Corporation portfolio. Now to conclude, we having covered the looking into the portfolio and having talked about the collateral and security structure, we'll shift gears and conclude with that second central pillar, which is, of course, how hard is my money working for me? You know, an opportunity can be as safe as the day is long, but if it is not competitive, if it does not outpace inflation, if it has negative real interest rates, then that still might not be the opportunity for us. So we're looking to provide a robust balancing of the best of both worlds. So with that, we'll cover the loan options. As again, you can see here the summary of what we have gone through already. But diving right into the first, our short-term option, our shortest duration being a 12-month loan, 1 year. What is your investment finance, what is your principal doing for you in a single year? Well, a substantial amount, actually. So this option comes with an annual current interest rate of 12%. That is an annualized rate of the cash flow. As you can see here, that boils down to 3% per quarter. So this option pays quarterly. So you divide that 12 by 4 quarters of the year to get that 3% quarterly interest payment. So once again, this is a fixed interest return. So by way of example, on a loan principal of $100,000, that would translate to a fixed $3,000 quarterly interest payment every quarter, in this case, for a 12-month duration. There is also an additional bonus that is paid out at the maturity of the loan. So after the 12th month, that comes in at an additional 2%, which translates therefore to an effective annual interest of 14%. So, you know, why we are so excited about this product as a family office is that we've been able to package within a very short investment horizon, a 1-year option offering cash flow on a quarterly basis with fixed returns, highly collateralized with custodial oversight, with a 14% effective annual interest fixed, is quite a bit of what we've been able, reflects a lot of the work that we've been able to put into and to make as part of the structure of this offering. And really, the other options increase from there. And that is beginning with the 24-month option, which you can see is very similar to the 12-month, sort of a sibling, a brother or sister to the first option, if you will. This has the same annual current interest rate and same frequency of payment, 12% annual, paying out, therefore, 3% per quarter. So you're receiving 3% on your interest per quarter every quarter for 24 months. However, in consideration for the slightly longer contract, this option has a slightly larger bonus paid out at the maturity of 5%. So that translates to a total return at the end of the second year of 29%. We have also structured a second option at the 24-month duration. And this option is designed for to be, you could think of more of a streamlined cash flowing option. Many of our clients, came back to us as we looked to refine our product offerings, and indicated that while they enjoyed the quarterly cash flow, perhaps in their specific life circumstance, receiving that more frequent interest payout on a monthly basis allowed them to better strategize around those interest payments, perhaps to help meet immediate expenses or to defray the cost of another debt, or even to fund the premium on an IUL, or a variety of other strategies that this can be, GLC product can be integrated with. This cash flowing option on a monthly basis would have value for these kinds of clients. So this option is 24-month duration, same annual current interest rate, except instead of paying quarterly, it's paying out monthly. So you're receiving 1% per month. Same example as before. If we have 100,000 principal, this translates to a $1,000 monthly interest payment every month for these 2 years. In consideration of the more frequent, the higher frequency of payment of interest, this option does not have a bonus at maturity. So you can see this as pure streamlined cash flow for those who benefit from that increased recurrence of the interest payment. Now, the fourth and final loan option is what we call our deferred or accrued returns option. Also, one can think of this more as a growth-oriented option, because this option does not have any cash flow, but pays out rather as a single lump sum at the maturity of the loan, so after the 36th month. However, in consideration for that deferred return, GLC being allowed to utilize this full financing without any interest payment until the 36th month, that allows us to offer a more outsized and robust total return. This option paying a 100% interest return at the maturity of the loan. Another way of putting that, to simplify it, is that in 3 years, you are doubling your principal. $100,000 loan principal on the 36th month would receive $100,000 in interest along with the principal. That is, if the client chooses to terminate the contract, but they are also perfectly can avail themselves of the option to renew that should they so choose. So, between these different loan options, we've sought to give a tremendous amount of variety to our clients who, depending on your life circumstance and situation, one of these may be better suited to you than one of the other options. Last point I will note before we close out is that all of these loan options are open and eligible both for cash funding from cash from the bank, as well as the use of qualified funds. Qualified funds meaning retirement account funds, whether that's an old 401k that you don't want to see hemorrhaging funds in a volatile market, or a traditional IRA or Roth, or whatever form that may take. We have a designated process for utilizing those funds. We have gone through compliance with the directed IRA custodians who can custody this product and utilize those funds. So whether it's a cash investment consideration or trying to put those retirement account funds to better use, this GLC product is eligible for either of those sources of funding. So with that being said, I do want to thank you for taking time out of your morning, afternoon, or evening to sit in on this presentation, and allow me once more, as the president of Sanders Family Office, to welcome you as a guest, and again to emphasize that your access to this offering is a function of Sanders Family Office's close-knit partnership with the agent or the agent group who invited you. So I do encourage you very much to follow up with them. We do look forward to following up with you ourselves. And should this be suitable for you in your life situation, then we look forward very much to facilitating you through the process of establishing your GLC contract and to serving you in the entire relationship that falls and continues from there. Wishing you a very wonderful day, and we do look forward to catching you again on the next one.